It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader today. This video newsletter is brought to you by TradingTips.com.
Welcome to this edition of the TradingTips.com video newsletter. In this episode, we'll be looking at the HighLow Index, an easy-to-read breadth indicator that gauges the bullishness or bearishness of a particular index or exchange. Without further ado, let's begin. The HighLow Index is based on new 52-week highs and new 52-week lows for a particular index or exchange. The formula for HighLow Index is simple. Divide the number of new 52-week highs by the sum of new 52-week highs and lows, and then multiply the result by 100. If the number of new highs is greater than the number of new lows, then the result will be greater than 50, which is considered bullish. If the number of new lows is greater than the number of new highs, the result will be less than 50, which is considered bearish. This is the HighLow Index in a nutshell. The HighLow Index can be applied to a total of 8 indices and exchanges. I've listed the 6 most popular here: the S&P 500, the S&P 100, which is a subset of the S&P 500, the Dow Jones Industrial Average, and all 3 major exchanges, the Nasdaq, the NYSE, and the American Stock Exchange, or AMEX. The HighLow Index that goes along with each of these indices or exchanges has its own ticker symbol, which always starts with $R. I've included these tickers on the slide. Additionally, the HighLow Index can be used with the Nasdaq 100 Index and the S&P/TSX Composite. Those tickers are $RHNDX and $RHTSX, respectively. As stated earlier, HighLow Index values of greater than 50 are typically interpreted as being bullish, while values of less than 50 are considered bearish. As with many indicators on 100-point scales, 70 and 30 are key thresholds. Several consecutive 70-plus values can be viewed as a very strong indicator of a bull market, while values of 30 or less can be interpreted as profoundly bearish. But when using the HighLow Index, you need to be aware of a few shortcomings. For one, the results can be misleading if you don't look at them more thoroughly. For instance, if 2 stocks in the S&P 500 hit new 52-week highs and 0 have new 52-week lows, then the S&P's HighLow Index would be 100. But that's not nearly as bullish as, say, 20 stocks hitting new highs and 5 hitting new lows, which would give a value of only 80. High scores with few qualifying stocks can be misleading, as can low scores with few qualifying stocks. With that in mind, it becomes clear that the Dow Jones Industrial Average, which consists of only 30 stocks, can be hard to get a good reading out of. The larger the index or exchange, the more reliable its HighLow Index, which is why the Nasdaq Composite and the NYSE, along with the S&P 500, are probably the best to use. However, HighLow Index is purely based on past performance, and thus it is a lagging indicator, which is something else to consider. With all this in mind, let's look at a few examples. This slide shows the NYSE's HighLow Index in a strong uptrend. Below the price chart is the information for the HighLow Index, along with the 21-day simple moving average of its HighLow Index, which can be extremely useful. Note that even with the correction, the SMA stayed above 50, and the HighLow Index itself generally stayed above 70, which was a good indication of the exchange's strength. With this chart, we see the Nasdaq Composite's HighLow Index. Notice that the composite itself fell through support just as its HighLow Index began to fall below 50. This was a bearish sign. The HighLow Index barely ever got back above 50 after that, and was well below 30 for most of the period, indicating a very strong bearish trend. So in conclusion, the HighLow Index takes a look at all the stocks within a specific index or exchange, and compares the number of new 52-week highs to the number of new 52-week lows. The actual value is based on the number of new highs as a percentage of the total of new highs and lows, and multiplied by 100. This indicator can also be very useful for spotting long-term trends, particularly when values are below 30 or above 70 for extended periods of time. But it has shortcomings as well, most notably that it works much better with large indices like the S&P 500 or whole exchanges like the Nasdaq or NYSE. But also be aware of false readings achieved within low volatility markets, where few stocks reach new 52-week highs or lows. And finally, it should be noted that the HighLow Index is available as an indicator at StockCharts.com. We hope you've enjoyed this TradingTips.com video newsletter. Thanks for watching and good trading.
This Trading Tips video newsletter has been brought to you by Manny Backus's First Hour Trading System. Every day there's money to be made in the first hour of stock trading. This is the world of day trading, not for novices, unless you have a system, the First Hour Trading System. Visit firsthourtrading.com now and sign up for a free 30-day trial. You could make enough in the first hour of your day to take the rest of the day off. View more Trading Tips videos. Visit tradingtips.com. Sign up for our free video newsletters and become a successful trader today.